Hello student, I teach you financial management in very easy way. We are our Infoline organization designed simple notes for you. Please subscribe our smart channel on youtube.com and share it to all. Click on like and submit comment. Say thank you to Mashkamramahitser or Aary Infoline organization.blogspot.com. Please continue watching other simple notes in our channel on youtube.com. Financial Management Unit 2, Notes created by Mashkamramahit via Aary Infoline organization. We cover following: Techniques of financial statement analysis: comparative financial statements, trend analysis, common size statement, ratio analysis, classification of ratios, liquidity ratios, leverage ratios, activity ratios, profitability ratios, interpretation of ratios, interfere analysis. Comparative financial statement. Comparative financial statement analysis is a form of horizontal analysis where financial statements of two or more years or of two or more different companies or of a company and its industry are compared, analyzed and interpreted. Therefore, this technique of analysis is also called interperiod analysis, when financial statements of two or more years are taken into consideration, or interfirm analysis, when financial statements of two or more companies are taken into consideration. The following are the most commonly used forms of such analysis. 1. Comparative balance sheet. 2. Comparative income statement. 3. Comparative cash flow statement. 1. Preparation of comparative financial statements. Comparative financial statements refer to the statements of financial position of a business, which are prepared in such a way as to provide a time perspective to the various elements embodied in the financial statements. These statements include two types of analytical statements. They are comparative balance sheets and comparative income statement. In these statements, figures are placed side by side for two or more periods in order to facilitate comparison. They also facilitate comparison among two or more firms that belong to the same industry. Comparison may be regarding to profitability and financial soundness. Preparation of comparative financial statements. Comparative statements mainly show the following information for analytical purposes. A. Actual data in absolute money values, as given in the financial statements for the periods under consideration. B. Increases or decreases in various items in money values, and C. Increases or decreases in various items in terms of percentages. The following examples would illustrate the method of preparation of a comparative balance sheet and a comparative income statement with imaginary figures. Tentative conclusions. Total fixed assets have been added during the year 2002 by R'(S.55 lakhs, that is, about 5%, compared to 2001. For which long-term investments worth R'(S.50 lakhs have been realized. The level of current assets worth R'(S.42 lakhs has been reduced. Despite the increase in fixed assets, the total assets have been decreased by R'(S.37 lakhs. It implies that the addition to fixed assets has been partly financed by the sale or reduction of other assets. Increase in fixed assets and decrease in current assets reflect a poor financial policy. The relationship between the total current assets and total current liabilities is not satisfactory. Increase in the preference share capital of R'(S.100 lakhs might have been due to the fresh issue of shares for the redemption of debentures. Also, the increase in reserves may represent the redemption of debentures out of profits. 2. Comparative income statement. Similar to the comparative balance sheet, The comparative income statement contains the same columns and supplies the same type of information. It is illustrated below. The comparative income statement explains the relationship between sales and cost of goods sold and its effect on gross profit. Increase in selling expenses and office and administration expenses relating to the increase in sales should not be proportional. This will indicate clearly the efficiency of operations by showing changes in absolute figures and also in terms of percentage of the operating profits from one period to another. The Companies Act of India insists that companies should give figures for different items for the previous year together with the current year's figures in the profit and loss account and balance sheet. While net sales have increased by 33.33%, the cost of goods sold has increased by 25%. The percentage of profits has increased by 50%. The increase in total operating expenses is 25% only, which has increased the net operating profits by 56.25%. The overall performance in 2002 is satisfactory compared to 2001. The main limitation of comparative financial statements is that they fail to show the changes that have taken place from year to year in relation to total assets, total liabilities and capital or total net sales. Common size analysis eliminates this limitation. 2. Preparation common size statements. Common size financial statements are those statements in which items reported in the financial statements are converted into percentages taking some common base. In the common size income statement, the net sales are assumed to be 100% and other items are expressed as a percentage of sales. Similarly, in the common size balance sheet, the total assets or total liabilities are assumed to be 100% and other items of assets and liabilities are expressed as a percentage of this total, that is, 100%. Common size statements are also called as component statements or 100% statement because each statement is reduced to the total of 100 and each individual item is expressed as a percentage of this total. Example: the preparation of common size statement is illustrated below based on the imaginary figures used in the examples of comparative financial statements. Interpretation: the percentage of fixed assets to total assets increased from 58.83% in 2001 to 63% in 2002. At the same time, the percentage of current assets decreased from 30.47% to 28.31%. This indicates a poor current assets management policy. The value of investments has also decreased from 10.70% to 8.19%, which may be in order to finance the increase in fixed assets. The preference share capital has increased from 10.70% to 16.37% and reserves from 10.69% to 13.64%, but at the same time, the long-term as well as the current liabilities to total liabilities has come down from 51.87% to 42.72%. Compared to total current liabilities, the total current assets are inadequate. Hence, the working capital position is not satisfactory. In general, the financial policy of the concern is highly unsatisfactory. Interpretation: the gross profit percentage has increased from 33.33 to 37.50. This increase is more than proportionate compared to sales. This is because the increase in cost of goods sold is less than proportional. Similarly, the net profit percentage has also increased from 26.67 to 31.25. In general, the overall operating efficiency of the business is highly satisfactory. 3. Trend percentages or ratios. Trend analysis refers to the comparison of past data over a period of time with that of a base year. Under this method, percentage relationship that each statement item bears to the same item in the base year is calculated. Any year that is, the earliest year involved in comparison, or the latest year, or any intervening year, may be taken as the base year. As the purpose of this analysis is to highlight some important changes, the trend percentages are calculated only for some important items that can be connected with each other. The concerned item in the base year is taken to be equal to as 100, and then based on this, trend percentages for the corresponding items in other years are calculated. This method is a horizontal type of analysis of financial statements. The trend percentages are shown in comparative financial statements. Trend analysis is a useful tool for the management since it reduces large amount of absolute data into a simple and easily readable form. By looking at the trend in a particular ratio, one can see whether the ratio is increasing or decreasing or remaining constant. From this, a problem is unearthed and good management is observed. The base year selected should be normal and be truly representative of all years involved in the analysis. 2. The financial statements used for the analysis must have been prepared applying consistent accounting principles and practices. 3. The figures of the various accounting statements considered for the analysis should be adjusted for any price level changes, as compared to base year, before computing trend percentages. 4. Trend percentages should be studied along with the absolute figures on which they are based. This will enable us to know whether the change is significant or not. For example, one item may increase from R'(S.100 to R'(S.200, that is, 100% increases, and the other item may change from Rs.10,000 to Rs.14,000, that is, 40% increase. Of these two, the change in the first item is not significant compared to the second item. The trend ratios for the assets of a balance sheet are illustrated above with imaginary figures. Note: a separate column for the base year, 1999, need not be provided in the comparative balance sheet. Interpretation: from the above statement, it is clear that both the fixed assets and current assets have registered an increasing trend. This is an indication of the company's growth over the period. Similar to this analysis, trend percentages can be computed for the important items of the liabilities side of the balance sheet and of the income statement. Solution, and comments of one illustration. Individual as well as total current assets have decreased in 2002 when compared to 2001. The total current assets have decreased by 34%. Investments have also decreased by 37%. Amounts realized from the assets have been mainly used to repay current liabilities, decrease by 52%, and the balance used for the purchase of fixed assets. Fixed assets, particularly buildings, have increased significantly by 146% and other assets by 32%. It is heartening to note that these assets have been funded through the issue of debentures by 63% and equity and surplus by 65%. Generally, there is an overall increase in total assets in 2002 over 2001 only by 20%. Thank you. Notes created by Aary Infoline organization. With the help of Mashkamradimahite. Please subscribe our smart channel on youtube.com. And share it. Click on like and write your comment. AaryInfoliniorganization.blogspot.com Please continue watching our channel on youtube.com. Thank you. www.google.com